This presentation covers accounting for legal reorganization and liquidation. This is part 1. Now, conditions or events that could signal an entity's inability to meet debts. Several of the conditions or events that could signal an entity's inability to meet debts as they come due include, and these are just some of the things that are indications that there are problems, recurring operating losses, working capital deficiencies, negative cash flows, loan defaults, work stoppages or other labor difficulties, legal proceedings, loss of a key asset such as a patent or franchise. The Bankruptcy Reform Act of 1978 strives to achieve 2 goals in connection with insolvency: a fair distribution of assets to creditors and the discharge of an honest debtor from debt. Now we have first voluntary bankruptcy. The company itself files the petition with the court requesting bankruptcy. When facing the prospects of several losses or a difficult operating environment, companies may also seek voluntary Chapter 11. Involuntary bankruptcy. The company's creditors file a petition with the court. This can result in the company being forced to liquidate under Chapter 7 or receive protection under Chapter 11, which would require they reorganize. They stay running, but they have to reorganize. And there's other criteria they have to meet, which is covered in Part 2 of this presentation. So, how will the debtor be discharged from its obligations? Under Chapter 7, the debtor's assets will be liquidated and the proceeds distributed to the creditors based on their priority status, or under Chapter 11, the debtor will be permitted to reorganize and continue operations. These chapters refer to the relevant sections of the Bankruptcy Act reform. Now, criteria for forcing involuntary bankruptcy. There has to be 12 or more unsecured creditors. At least 3 must sign the petition. Those that sign must have total unsecured debt of at least $15,775. If there are fewer than 12, only 1 must sign, and the minimum debt limit remains $15,775. Debt limitation balances are adjusted every year, just so you know. Now, with creditors, we have classifications of who gets paid first when. Now, fully secured creditors. Net realizable value of collateral is greater than the amount that's owed. So, for instance, if you borrow money from someone and you secure it with your land, and your land's worth $100,000 and you owe them $100,000, that would be fully secured. Partially secured. Net realizable value of collateral is less than the debt. In that example, you borrow $100,000 and you secure it with some equipment worth $80,000, which means part of that is not secured. Unsecured with priority. This would be all other debt, but ahead of it would be specific items that have to be paid. And then unsecured is what goes to the stockholders, and as we know, there usually isn't any left by the time we get there. Now, unsecured liabilities having priority. Administrative costs related to the liquidation. Now, the reason they do this is because they want to hire somebody to handle the liquidation, and those people are not going to do it unless they know they're going to get paid. So that the company can keep working, debts that arise between the filing date and the issuance of an order of relief also get priority. Employee claims for wages earned or benefit plan contributions earned during the 180 days prior to the filing, but it's limited to $12,850 per employee each claim. 4, customer deposits, but that's limited to $2,850. And then government claims for unpaid taxes. Now, on the statement of net assets, assets are reported at the estimated amount of cash or other consideration expected as a result of the liquidation process, a figure not necessarily the same as fair value. All of the assets of the company that can be used to generate cash during the liquidation process are reported. Debtors' assets and liabilities are reported according to the classifications relevant to a liquidation. Assets pledged with fully secured creditors, pledged with partially secured creditors, available for priority liabilities, and unsecured creditors. That's how assets have to be labeled, and debt has to be labeled as liability priority, fully secured, partially secured, and unsecured. Now let's take a look at an example and see what this looks like. All right, Danny's Corporation is to be liquidated. It has the following liabilities. They have income taxes, a notes payable 120, but it is secured by land with a fair market value of 90,000. So we would say that this is a partially secured liability. Accounts payable, we have salaries payable for 2,000 employees. We can see that it's below the limit for each one. We have bonds payable, and then we have administrative expenses for liquidation. These would be the cost to wind down the company. Now here is the estimated fair market value or cash value of the current assets. We have land and building. Now, how much will each be paid at liquidation? But first of all, we need to figure out what are our free assets. These are assets that are not pledged to cover debt. So we have current assets at cash basis. We have building and equipment. And that gives us total free assets of 145. If you notice, we don't have the land up there because it is it's secured for one of our debts. Now we have to subtract from that liabilities with priority. That would be the salaries payable, the income taxes, and the liquidation costs. Now we subtract that, and it tells us we have free assets available to cover our partially secured and unsecured liabilities. Now we have notes payable. We have 30,000 of that that's unsecured. We have all of the accounts payable, and we have all of the bonds payable, for a total of 185. So now we need to figure out what percentage is available to unsecured creditors. So we would take the 111,000 and divide by 185, which tells us unsecured creditors are going to get 60 cents for every dollar that is owed to them. So now let's look at payout and liquidation. This is the schedule. This is how it appears in your homework. So what I've done is recap this so you can get a better look at it. So remember, we have total free assets of 145. So here's what we look like. We show we're going to pay all the income taxes. We're going to pay part of the notes payable because 30,000 is unsecured. So we're only going to get 60 cents on the dollar. We're only going to get part of the accounts payable. We're going to pay all of the salaries payable, only part of the bonds payable, and all the admin liquidation expenses. So the total amount that will be paid out is $235. If we take away the cash from the land, we know that again our total free assets were $145. Now let's take a look at one more example to make sure you understand how this works. Company is going through Chapter 7 bankruptcy, and based on the following accounts payable, what would be paid out for salaries, accounts, notes, and bonds payable? And in this case, we have, we have inventory, and it has a cash value of $39,000. We have land that has a cash value of $120, and is secured with a notes payable. We have a building with a cash value of $180, and that reflects the bonds payable. And let's see, we have salaries for 4 workers. It's still under the minimum amount. We have accounts payable that are unsecured. So now we can go through and make up our schedule to figure out what are our free assets. We have cash of 30. We have receivables that only have a value of 15,000. We have inventory of 39. And then we have the difference between the cash value of the land and the note that is secured against it. So we have 10,000 left there. So that means we have total free assets of 94,000. We then take away liabilities with priority, which would be the salaries payable, and that tells us free assets are $84,000. So we now list our partially and unsecured liabilities. We have the bonds payable. We have the accounts payable. And so we have unsecured liabilities of 210. We take the 84 and divide by 210. In this example, we're only going to get 40 cents for each dollar owed. Now we'll go back and do a recap. Again, all the salaries would be paid, 40% of the accounts payable, all of the notes payable, part of the bonds payable, and the total payout would be $384. If we take out the secured and partially secured, we get our same total free assets of $94,000. So that concludes part one for what happens when you liquidate a company.